The Thanksgiving Everything rally is set to continue. Futures and treasuries rise as Kevin Hassett emerges as top Fed chair contender.
Hello again and welcome to The Week Ahead on Nomura Podcasts. I'm your host, Andrew Ticehurst from Nomura's Global Markets Research Team, and today's Friday the 28th of November. Well, we're heading into a Thanksgiving weekend in the US as we put this podcast to bed, and markets this week appear to have been giving thanks too. As you heard there from Vonnie Quinn from Bloomberg, equity markets and risk assets have had a couple of good days this week, underwritten by the tech sector and by growing market expectations that the Fed will deliver a 25 basis point rate cut on 10 December. So this week we'll be checking with David Sieff in New York, Nomura's chief economist for developed markets, to discuss the Fed outlook and the latest US data, with the US data taps turning back on post the end of the US government shutdown. Over in the UK, Rachel Reeves is likely thankful too that the UK budget was well received by markets, with gilt yields lower on the day. So I'll be chatting about the budget with George Buckley, our chief economist for the UK and Europe, and we'll have a look at inflation in Europe too. And then in Asia, we have another chief for you, Sonal Varma, our chief economist for India and AEJ. We're going to discuss the Reserve Bank of India policy meeting next week, the macro outlook there, and key data coming out across the region next week. So all up, 3 chiefs for you this week, and I'm certainly thankful that they've been able to make some time for us. Lots to discuss, so let's dive in. So let's kick things off with the US. I'm delighted to be joined here again by David Sieff, Nomura's chief economist for developed markets based in New York. Hey, David, always great to get you back on the podcast. Thanks so much for this.
My pleasure. Great to be here, Andrew.
Okay, good one. Hey, let's start with the shutdown. This US government shutdown ended 2 weeks ago. The data taps have been turning slowly back on. Have we learned anything meaningful in the interim?
Well, emphasis on the word slowly. We are still not much less than 40 days behind where we should be on the data, and we will eventually catch up, but it will take some time. We did have this employment report for September come out. Now, the data came out 48 days late and roughly 70 or so days after they were collected. So it was a snapshot of the past. The report we think would say is mostly good, although that was tempered by the fact that the unemployment rate went up to 4.44% on an unrounded basis, making it so that someone who is dovish can certainly point to that as potential for signaling weakness in the labor market. But we would point out a number of things that were quite strong about the report and really made the unemployment rate in the report look like it was basically an outlier within the report. The first thing is that within the household survey from which the unemployment rate comes, there were a lot of jobs that were added. Now, this is not non-farm payrolls. This is a separate survey that people focus on much less. But when you think, why did the unemployment rate go up? Was it because the household survey had people losing their jobs, or because the household survey had people gaining jobs, but more people entering the labor force? And the latter is what happened, and that's much more benign. I would say that when you look at the establishment survey from which non-farm payrolls come, that was a much rosier picture and much more unambiguously positive. We had 119K gain in non-farm payrolls. That was well above both our and the consensus expectation. And I think critically here, we saw the breadth of job growth really spread. So for the preceding 3 months, for June, July, and August, we had private payrolls was seeing losses in most areas, and it was being held up to the extent it was positive at all by healthcare and education, which are largely acyclical areas. But here we saw job growth in a number of areas, and that is a really positive sign that cyclical areas were gaining jobs in September. Now, of course, here we are at the very end of November. So what we got from that report really was, as I said, a snapshot into the past. But it does show that as the summer ended, it appeared that there was some recovery in the weakness that had been pretty clear within the U.S. labor market.
Okay, so that is interesting. So some moderately encouraging signs there, at least.
Yeah, and I would also add to that, Andrew. We have had jobless claims essentially up to date throughout the shutdown. Although it wasn't being officially published by the Department of Labor, we had each week 46 odd states reporting. So we had a pretty good idea of where things were. Those are now current, and they have shown no signs of massive layoffs, which we think is also a pretty benign sign for the economy.
Yeah, agree. Those numbers are pretty good. Hey, let's swing this over to the Fed. There seems to be so much going on here. The meeting on 10 December is approaching. We're heading into the Fed blackout period. We've had no shortage of comments from Fed officials opining on what the Fed should or shouldn't do at that meeting. And now we've got Bloomberg reporting that Kevin Hassett's emerged as the clear frontrunner as the next Fed chair. So, yeah, lots going on. Can you share some thoughts there?
Yeah, well, there's a lot to unpack. First of all, when it comes to this December meeting, it really does increasingly appear that this is the battleground, so to speak, whereby the Hawks and Doves want to really fight it out. We have had, of the 12 voting members on the FOMC, 5 come out and pretty unambiguously state that they are in favor of a pause or of a skip, whatever it is, but of not cutting. And 4 pretty unambiguously come out and say that they are in favor of a cut. I think that so that only leaves 3, including Chair Powell, who have either not opined or have been a little bit ambiguous enough that they could presumably support either decision. So I think this is very much up in the air at this point. We still think that it's more likely than not that the Fed will not cut in December. That's very much against market pricing. But I think that market pricing really doesn't reflect that. It seems pretty clear that Powell has not made up his mind yet. Powell has really focused in on minimizing dissents. It looks like he's going to have a bunch of them no matter what, but you still want to minimize something that's going to be fairly high. And so that's something that he just has to deal with at this point and see what course of action he can take to minimize dissents. I think that that's going to require him to have conversations with the other 11 voting members on the FOMC, figure out where things are. And it's very likely that we get some signal via a press article, probably from Tim Rose in the Wall Street Journal, possibly also Colby Smith in the New York Times, that gives an indication. But that's probably not coming until later. We've been pretty bullish on Kevin Hassett's prospects for quite some time because Hassett is a real insider. He and a real clear Trump loyalist, something that we have thought Trump wants. So the list of people who've been considered for the Fed, first of all, is not necessarily an exhaustive list. It's just the public list. But more than that, all of the people on the list are probably Trump friendly, but very few of them have demonstrated track records of extreme loyalty to Trump. And I think that's something that Trump views quite positively. So it's not a surprise to hear that Hassett is the frontrunner for this. I would say, though, that it could still be quite some time before we hear, and things can change very quickly. So definitely, it was a headline that people paid attention to, as well they should. It was in line with our view, but I certainly don't think that it is definitive in any way.
Okay, got it. Yeah, so much going on there. Thank you for taking us through that, David. I hope you have a great Thanksgiving and a good week ahead.
Thank you so much.
Chancellor of the Exchequer, Rachel Reeves, has been able to expand her fiscal buffer to £22 billion. This is according to an early release of the Office for Budget Responsibility's forecast.
Let's swing across to Europe and welcome George Buckley back to the podcast. George, let's start with the UK budget this week. I played a little snippet there courtesy of Bloomberg TV. Aside from the kerfuffle with the early release of some of the information there, what was the substance? What were the highlights?
Well, there were quite a few highlights. I mean, I think one thing you can say about Rachel Reeves is that the last 3 fiscal statements have certainly been interesting and exciting, and this one didn't fail to impress. I think the number of individual measures contained in this budget were probably the most I've ever seen. There were almost 90 of them, so it's quite a lot to digest. But in terms of the stuff that we look at, which is the aggregate numbers and what they're doing, it looks like they're doing at about 1% of GDP fiscal tightening. A lot of that is backloaded, maybe not if you add all the last few fiscal statements up, but certainly in this budget itself, the measures were backloaded. They raised the headroom, which is good, and some of the tax increases were based on tax compliance and efficiency gains, but other ones were based on actual tax increases, like the freeze to the income tax thresholds and various other things. But does it change our view on the Bank of England? Probably not. I still think that the bank will look at this and say, well, they're tightening policy, but they're not tightening it just yet. They're tightening it at the end of the horizon. They're probably even loosening policy a little bit in this budget in the near term. So all in all, I think it's still consistent with rate cuts because they are lowering inflation with some measures, but it's also consistent with being just a bit cautious on those cuts.
Okay, got it. Hey, let's turn to look at the data calendar next week. I think aggregate inflation data could be the highlight. What are you looking for there?
Well, it's an interesting time you asked this one, Andrew, because we're actually recording this just before the Big Four, Germany, France, Italy, Spain, published their inflation numbers on Friday of this week. So when this podcast is due to go out, and we get the aggregate numbers on Tuesday of next week for the euro area. So we're in a sort of the middle ground there. But I think what you can say is that inflation's close to target. It's probably going to stay close to target for some time. That's certainly our view. It's certainly the view of the ECB and the consensus. There's not really probably much to push it away. So something maybe a little bit above target, but not very much so. And obviously we get the full data next week. But between now and then, we are going to receive some country data, and that's going to be very interesting.
Okay, got it. And just finally, George, moving from inflation to the central bank, inflation is obviously key for them. I would think from this distance, the ECB's done fairly well. You know, I think as you've been describing, growth in Europe's picking up and returning towards trend. Inflation's pretty close to target and cash rate's about neutral. What's your sense? Has the ECB done a pretty good job here? And where are the risks? What might get them to move either up or down from here?
Well, I think they have done a good job, and that's certainly what the ECB themselves are saying, probably not surprisingly. They're saying we're in a good position on interest rates where we are. And the reason they're saying that is because they think neutral is somewhere between 175 and 225, quite a narrow range, but we are right exactly there, 2%. So we've got neutral rates, as you say. We're looking at broadly trend growth expectations. We've got inflation close to target. You know, what is not to like about this situation? Why would you move interest rates when everything is at its sort of starred rate, the star variables, the R star and the equilibrium level of interest rates and trend GDP and target inflation? And so it almost feels like to get a move away from that neutral level, you need to see some sort of shock. And of course, a shock by definition is an unknown. It could go in either direction. We have seen rates being cut for quite some time. That could be the case that the next move is therefore back up again as we start to see those rate cuts have an impact on economic growth, and maybe fiscal policy in Germany starts to kickstart the euro area, but there doesn't seem to be much likelihood of that causing inflation. So for the near term and maybe even the medium term, I don't think we're going to see interest rates move from these levels for quite some time.
Okay, good one. That is interesting. And yeah, I think that is a bit of a theme. We've had a lot of rate cuts in the last 12, 18 months, but we're not forecasting too many more for a bunch of countries going ahead. And yeah, for some, there seems to be a bit of two-way risk. George, thanks again. Great to speak with you.
Thanks, Andrew. You too.
Now, finally, let's move to Asia and have a chat with Sonal Varma, Nomura's chief economist for India and AEJ. Hey, Sonal, thanks for joining.
Hey, Andrew. Thanks for having me.
Terrific. Reserve Bank of India is out next week. That's probably a big highlight on the calendar. What are you expecting there?
Yeah, so we're expecting a 25 basis point rate cut to 5.25%. I would say it's largely in line with consensus. India actually is in a very unique position because we have high headline growth below target inflation. So there's space to cut. The question is more about the right timing. Our own view is the arguments for a cut are stronger. So inflation, we think, is likely to remain below the RBI's 4% target for the next 1 year. We've still not had any trade deal with the US, so tariffs remain quite high at 50%. Transmission of a lot of the past rate cuts has progressed well. And we think a cut would also be consistent with the RBI's dovish communication in the run-up to this meeting. I would say, regionally, we've seen a shift towards the theme of end of easing cycle. So the question is whether we'll see something similar for the RBI. Consensus does believe that this next cut is going to be the last cut in this cycle. We think there'll be another one after this one. So we see the terminal rate lower at 5%.
Yeah, okay, good one. Yeah, no, that is interesting. End of easing cycles appear to be approaching in a number of countries across the region. Would you say, we're looking for this 25 basis point rate cut? Is it more a case that low inflation allows the rate cut rather than it's not weak growth that requires one?
That's exactly the case. And, which is what makes this particular decision a close call, because you could make an argument on both the sides. So we do think it's low inflation that provides the space. But also, Andrew, I think while the spot growth numbers are very strong, the full impact of the US tariffs is not yet seen on the growth data. So over the next 2, 3, 4 quarters, we do think while growth will be steady, the output gap is unlikely to become positive.
Okay, that is interesting. So, so maybe some downside risks from tariffs that we haven't yet seen, but more broadly, it sounds like you're fairly positive on India.
Yeah, I would say so. I think, 2025 has been quite challenging domestically. We've seen a slowdown in cyclical sectors. The 50% Trump tariffs were a negative shock. But what we've also seen this year is monetary liquidity and I would say macroprudential easing. Government also announced personal income tax and GST cuts to boost consumption. So all these measures we think should be positive for financial conditions and support, domestic demand as the year progresses. And we also think the US tariffs will reset lower at 20-25%. So, and I think in addition, what is important for India is government is doing actually a lot of structural reforms. So recently they announced politically difficult labor market reforms, and we expect more reforms around ease of doing business, deregulation reforms to come through. So overall, we do think India is placed well both cyclically and structurally.
Oh, that's really nice to hear. Positive structural reforms. I'd actually like to see some of that down here in my part of the world, Sonal. Look, finally, anything else you're watching across the region next week?
Yeah, it's actually a busy week on both the growth and inflation front for Asia. So on the growth side, we'll be watching Korea's November exports, where we think there should be an improvement. So looking for a pickup from 3.5% to 7.5% in November, both because of higher chip as well as auto exports. We also get China PMIs, which we think will be a mixed bag. So the official manufacturing PMI, we think, will be unchanged at 49 because of the weakness in infrastructure and property investments. The unofficial manufacturing PMI, which surveys more SMEs and exporters, we're expecting a slight improvement to 51 from 50.6. It's also a busy week for CPI inflation across the region. This week, Singapore core CPI surprised on the upside. So we'll be watching whether this was unique to Singapore or whether it's a trend across more countries in Asia.
Oh, that is interesting. We had higher inflation down here in Australia this week, October data. So the end of easing, that cycle that we've been talking about, I think is certainly applying to Australia and to New Zealand as well. Australia, by the way, publishes Q3 GDP data next week, and we see some upside risk on that one. Okay, Sonal, let's end it there. Good one. Thanks so much.
Thank you very much, Andrew.
Okay, so there you have it, our views on major market themes and what to look out for next week. This podcast has been written by Andrew Ticehurst and Nomura's Global Markets Research team and expertly edited and produced as always by John Dalton. Thank you for listening in. If you did enjoy this podcast or would like to hear more, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud or wherever you get your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log into NomuraConnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.